Okay, it's Thursday, March 7th, 2019. We're looking at the pound dollar 1 hour time frame. So, talking to a student just a little while ago, we were talking about the the Fade the Double Zero trade and wanted to know more details about what it is that I'm doing, when I decide to use it, and when I think other times I should avoid it because it looks like it would be a more risky trade. So, if you watch some of the videos, you'll notice that I have the continuation breakout trade. I wait for the continuation breakout trade, meaning that I wait for a range of consolidation to solidify, and that is due to for many different reasons. I mean, the market could be expecting major economic data, interest rate decisions, political statements, votes, elections, things like that. Whatever the cause is, whatever it is, the market sort of moves in sideways into consolidation. We all know what that looks like, but with that particular technique, the continuation breakout trade, I've developed a way to quantify what consolidation is. It's not subjective to me. It's something that has to have specific boundaries, highs and lows, and then specific things need to take place in order for me to determine that I should trade the breakout, and it's not going to turn into a head fake, and then it's going to continue to trend in the direction of the breakout. The other trade strategy that I use is a reversal. We all have reversal techniques and things like that. Sometimes we just wait for, people will wait for candle patterns. But I use these reversals at specific locations. I see reversals, candle patterns happening inside of the middle of consolidation, and they don't always work. So I prefer to wait for price to approach support or resistance and then wait for the reversal pattern to develop. And I use specific indicators to help me confirm that it's, that there's more, it's more likely to be a successful reversal trade that I can trade to a specific take profit level. So again, before I even get into a trade, I need to identify and know where my target is, or I won't take the trade. I don't want to get into a trade and just hope that it's going to move in a direction that I'm trading to, but with no real boundaries, no target, no, I don't want to be looking at the numbers in my trading platform. That's not going to provide you with the consistency that you need, trade after trade after trade, year after year. You've got to have a target. So you'll notice that quite often, when there is some movement or activity inside of the middle of consolidation, I just leave it alone. And very often, I mean, you don't want to sell at support. You don't know if it's going to bounce. You need more confirmation. That's what I do with the continuation breakout trade. So before trading this fade the double zero move, which I was looking to set up, that was really the initial setup, was the fade the double zero. Now, I didn't create the fade the double zero technique. That's been around for a long time, but I have added my own twist to it, and I incorporate again certain indicators that will help me confirm that it's going to be a reversal because of the divergence. And then again, with fade the double zero trades, I wait until it happens, or I prefer to execute them primarily when they reach support or resistance. And that's pretty much what we saw here on the pound dollar. So then I just have to wait for the candle pattern. So I can switch to a 30-minute. Sometimes I'll be looking at the 15-minute chart just to get a heads up on what it's doing. But I'm also looking at the CCI indicator, and I'm using percent B and bandwidth. These are indicators that I use with the Bollinger Bands. They help me identify the divergence. They help me identify that it's going to be a bounce that I can trade off of. And that's exactly what I traded here. I'll go ahead and open this up. That's exactly what I traded here, this bounce, which was pretty sharp here on the pound dollar. If you saw it or if you tried to trade it, you remember that this was a pretty sharp bounce to the upside. Now, something that I need to share with you, if you're going to try and follow up with this fade the double zero technique and research a little bit more, I remember Kathy Lean back in like 2000, I don't know, maybe it was like 2005, 2006, or something like that. She wrote a book and she was talking about the fade the double zero. So lots of people have talked about the fade the double zero. It's been around for a long time. But you have to know that it has its share of possible failed trades. So it depends on the timing, where you take the trade, where you execute the trade. You can improve the odds of the trade working out in your favor if you're paying attention to certain things like this, like waiting for it to actually bounce off of a significant price low rather than just the 00 number itself. Sometimes the 00 number could be in the middle of consolidation and it might not be that effective. So you would, maybe pass on that particular trade. There's nothing wrong with passing on a trade that looks more risky to you at that moment. And then waiting for an opportunity where it sets up where it's not as risky. You've minimized the possibility of it failing, and then you're looking at what everybody else is looking at and trading that reaction. And very often when we see price approach support or resistance, we either get a bounce or a breakout. I mean, that's not the only thing that can happen there, but that's usually what we get, especially if we do it at certain times like the New York trading session. We're more likely to see more consistency in the trades and the movement during the New York session than, let's say, the Asian session at certain times when it's just sort of moving sideways and you end up babysitting a trade for 12, 13 hours. That's exhausting. So there's not that consistency. Here you can see on this 1 hour candle that there was a pretty consistent move once we got into the trade straight to that target. Now, the targets are 40. So in other words, if you're not familiar with it, let me walk you through it. So there's the 00, the 1.3100. I have it marked down there at 96 was actually the support low, but with the crosshairs, I'll put the 00. There's the 00 right there. So when price goes through the 00 to the downside, the idea is, and the way some people trade it, is that you just immediately go long the opposite direction. Now, you want to make sure that there's no economic data after you get into the trade, things like that. You want to make sure that all the economic data is out of the way before you consider trading something like this. Now, you'll notice that with some of these fade the 00s, they work even before the economic data is delivered, and sometimes they'll work right in the middle of these consolidation ranges. And that's what I'm talking about. Sometimes they work, and sometimes they don't. And what I do is work harder at trying to identify the possibilities of when they won't work and then just stay away from it. And I know that even though I do that extra work to identify that it's an even more risky trade, sometimes they work anyway. And that's what the market does. It's always going to be testing you and tempting you to break your rules. But I'll just sit and wait. I've failed too many times trying to guess. And instead now, what I do is just wait for more solidified confirmation, like a bounce off of an actual support low, with the addition of the fade the 00 move. That makes a lot more sense to me. And then I start looking for the divergence here in the indicators. There's a lot more, of course. I mean, you want to track to see how far it's already moved, that kind of thing. Daily average trading ranges. Is this one likely to break out? Is there any economic data afterwards? That kind of thing. There's a lot more that goes into it, of course. But again, these are just the basic parameters and structure that you could start thinking about when you get into some of these trades. Ask yourself, is it likely to work? Am I trading it at a level where I could see this bounce? And also the timing. So is there more people participating at that time? Is there more people trading in the market right now? Is there more volume? That kind of thing. You want to ask those kind of questions before you get into some of these trades. Now, I mentioned that the idea is that you go long as soon as it goes through the fade the 00, and then the target, when it pops up and goes back up the opposite direction, would be 40. So in this case, we would be trading it to the 1.3140 level. So this is another problem with this technique. Sometimes it doesn't hit the 40. Sometimes it'll do what it's doing now, pull back down and bounce and then turn around and go back up again. So it's still possible that it could go back up there. And your stop is going to have to be below the price swing low here, which opens it up to quite a bit of, you're sort of trying to balance where the risk to reward. Most people want it to be a 1-to-1, that kind of thing, or even higher. And when you use the support low, you're sort of opening up the stop loss. Sometimes the stop loss is greater in a situation like this, or it could be, than the actual profitability of the trade. It really depends on where you get into the trade as well. So what I do is I go to a 15-minute or a 30-minute and I look for the reversal candles along with everything that I just mentioned here that's helping me confirm the possibility of a bounce. So I need to find support or a reason for a bounce first, and then I start looking at the candle patterns and the divergence before I even get into the trade. So I would look for an engulfing candle pattern or, an evening star or morning star, depending on which direction you're trading it in, and wait for that candle pattern to actually develop. So again, I wait a little bit longer than most people to get confirmation, but at the same time, I'm more protected because I'm more convinced that it's going to work. I know that the trade's likely to work. And then I'm also prepared for the fact that it just might not hit that 40 target. It might stall. So I was able to take the profits as I saw it starting to stall. You have to have in your trading system preparations and sort of backup contingency plans, because sometimes these trades don't work. Even every trading system, as great a trading system as it could be, it's not going to work 100% of the time. So you have to have a backup plan. What is part of my backup plans? Well, I have different backup plans and scenarios like this where I'm in a perfectly good trade. I'm up good money, 20, 27 pips, 25 pips, something like that. And I see that it's so I have to have ways to identify that it's stalling and it might not hit that last final take profit level that I would normally expect it to go to. I have to have that as a backup measure. So I studied and started to then I learned to identify how to determine if price is stalling and it's not going to hit that final target. So have that built into your trading system. So not only do you need to have a system that tells you precisely when to get in, where to place your stop, and where to take your profits, but also then again preparing for those moments and those times when it's not going to hit that target. How do you deal with that, and how do you identify that? So that's another study, right? That's more work that you got to do. That's how I built my trading system. I went back in and I had to figure out all of these different ways to protect myself. Sometimes it's just a matter of scaling out at different levels as you're in a good trade before it actually hits the final target. That's another method. People will scale out at different locations. So you have to figure out where you would scale out that's comfortable for you based on your entry and your stop loss. So hopefully that helps. Basically, this was a fade the double zero with a twist. Again, it was at support, and I do it my way. I trade this fade the double zero my way. I teach how to do this in the membership area. And you also want to have these backup plans just in case it doesn't hit that final target. What do you do? How do you protect yourself, and how do you lock in profits?